And welcome to the launch of the China Capital Markets Series, a collaboration between the Australia-China Business Council, China Capital Markets Industry Group, China Construction Branch, Sydney Branch, and OMFIF, the official Monetary and Financial Institutions Forum. My name is David Olsen, and I'm the National President of the Australia-China Business Council, and it's my honour to open the series and to be your MC for the first part of this session. We have an extraordinary lineup of talented speakers today from Beijing, Shanghai, Hong Kong, and around Australia. We'll provide some short introductions to them as we move through the program, but I would encourage you to read their bios in the material sent to you previously. Apart from the primary organisers, I'd also like to thank our event supporters, the Australian Trade and Investment Commission, Austrade, Auscham Beijing, and Auscham Shanghai for their contribution to today's event. The event will be recorded and a copy will be sent to all registered participants in due course. There will be a panel session after our introductory speeches, and I understand that some members of the audience have already submitted questions. Unfortunately, because of the large number of people online today and the time commitments, we won't be able to take live questions. But if you want to submit questions, I'm sure the speakers will take note of them and may hopefully get back to you in due course. As some of you may know, I have had a long interest in China's capital markets for some time. But in the last couple of months, I've been talking to dozens of people representing banks, asset owners, funds managers, and professional services firms. And many of you I know are in the audience today. They all recognise that China's capital markets present immense prospects for foreign financial institutions, international businesses. They have confidence that the current challenges we face will subside. But they also recognise that the challenges are unique and a calculated, clear entry strategy and long-term commitment are a requisite for success. With that background, the focus to this series of webinars is firstly to provide deep insights from experts into the direction and, importantly, the details of China's financial market liberalisation story. And secondly, to explore and promote the opportunities where Australia's financial services sector, especially our institutional investors, can collaborate commercially with China. The webinar series will continue over coming months and will examine China's markets in many detail. We start today with a focus on China's fixed income market. It's now my pleasure to provide some introductory comments, Ms. Yanli Zhao, the Deputy General Manager of the China Construction Bank, Sydney Branch, to deliver some opening remarks. Ms. Zhao joined the branch in late 2012 and is now overseeing the bank's treasury and financial markets business. With over 25 years in the banking industry, Ms. Zhao has extensive experience in asset and liability management, risk management, compliance and internal control, corporate and institutional finance, international trade finance, and many other aspects, including IT and accounting. Prior to her role as the branch DGM, she served various positions in International Business Department of China Construction Bank Head Office. Now hand across to Ms. Zhao.
Thank you, Mr. Olsen, for your kind introduction. Distinguished guests, ladies and gentlemen, on behalf of China Construction Bank Sydney Branch, I'd like to extend my sincere welcome to all of you for attending CCBS OMFIF China Capital Market Series, with the first event on China's fixed income market. I'd like to take this opportunity to acknowledge the support from our event partners, the official Monetary and Financial Institutions Forum, Australia-China Business Council, Australian Trade and Investment Commission, and Australian-China Chamber of Commerce, both in Beijing and Shanghai. With the launch of QFII program in 2002, licensed foreign investors were allowed to enter into China's stock market. That is the milestone remarking the openness of China's capital market to worldwide investors. Since 2011, with the launch of RQFII, Chinese government issued a series of policies to reform the market, opening the door widely to welcome the international investors. Among those are the most important policies, including the one jointly released by People's Bank of China, PBOC, and the State Administration of Foreign Exchange, SAFE, in 2019, to remove the restrictions on QFII investment quota. In August this year, the China Central Depository and Clearing Company Limited and the Shanghai Clearing House jointly released the business rules for the settlement of the transfer of defaulted bonds on maturity by bond custody and settlement institutions in the national interbank bond market, aiming to improve bond default resolution mechanism and protect the legitimate rights and interests of investors. The most recently released policy on QFII and RQFII, effective on the 1st of November 2020, creates a more convenient environment for investors. In the market, there are many channels and methods available for foreign investors to get into the market, such as Stock Connect, Bond Connect, CIBM, QFII and RQFII, etc. Foreign investors can also transact bond repos, ETF, FX spot, derivatives, as well as China bond, panda bond issuance in China's domestic market. In recent years, the stock market capitalization, the balance of bonds, and the trading volume of commodity futures of the Chinese market all ranked top globally. Foreign institutions have increased their holdings of Chinese bonds for 22 consecutive months as of September this year, with the scale of their holdings climbing every day. In the first 9 months of 2020, China's interbank bond market witnessed 719 billion Chinese yuan, equivalent to $110 billion increase of bonds held by foreign investors. China has become the world's second largest bond market, with circa $16 trillion outstanding. There were a total of 870 foreign institutions from more than 60 countries and regions qualified into China's bond market via CIBM and Bond Connect. In September, FTSE Russell announced the Chinese government bonds will be included in the FTSE World Government Bond Index, with inclusion scheduled to start in October 2021. China's government bonds are already a part of JP Morgan and Bloomberg Barclays Index suite. It is widely estimated the full inclusion will attract around $120 billion of foreign inflows into China's bond market. Nowadays, China is widely regarded as one of the most attractive markets globally for investors, with diversified products, safe and convenient investment channels, and relatively high returns. We believe this market deserves attention. That is why today we are here. We are trying to set up a platform that may connect Australian investors to the promising Chinese capital market, with the hope to be some help for you to further understand the market from its policies, infrastructures, channels, and products. Finding ways that CCB, as a bank with global investor service capabilities and close ties with worldwide capital market players, can facilitate the access to and participation in the market. Our guest speakers and panelists from both China and Australia will join us for more details shortly. I do hope you will find the webinar insightful. Thank you for attending.
Thank you, Ms. Zhao, and thank you very much for those welcome words and for CCB's leadership in this area. I think your comment about the market deserving attention and setting up a platform for Australian companies to be able to explore it in more details are very timely, and I'm sure we're all looking forward to the coming remarks now. I now have pleasure in introducing Mr. Michael Chen as our opening speaker. Mr. Chen is the Managing Director and Acting Head of the Overseas Client Department at China Central Depository and Clearing Company. He's going to provide an overview of China's bond market opening. Mr. Chen joined CCDC in August 2018 and is responsible for promoting CCD's global investor service capability. He works closely with overseas central banks and investment institutions, intermediaries, and domestic regulators to advance bond market opening and to facilitate the access to and participation in China's interbank bond market. Now I hand across to Michael Chen.
Thank you, David, and thank you for the host to invite me from CCDC to give this presentation to everyone here. This is Michael from CCDC. Today, I would like to spend about 20 minutes to give you an update on China bond market opening as well as its future development trends, more from a local CSD perspective. Next page, please. Next page, please. As we all know, China currently is the second largest. Previous page, please. As we all know, China currently is the second largest bond market in the world. I think in the last 10 years, it rankings starting from out of 10 to currently number second next to US, but already surpassed Japan I think in last year. This market, I think for global asset owners, it's too big to ignore. Besides its size, second largest, I think the market attractiveness is not only the large, but also the huge potential for further growth. In the right chart, you can see China currently, its bond market outstanding compared to its GDP. Currently, the ratio is just 100%, it's 1 times. But look for mature markets, US, UK, even like Malaysia, the ratio is about 200% above. So I think the global average ratio indicates we still have very large room for the China bond market further growth. And also currently, in terms of the foreign ownership, currently China foreign ownership in China bond market currently is only 3%. So when we look at about Malaysia, Thailand, and even India, currently it's all above 10%. Even some US is above 40%. So I think even for the overseas investors' participation, it's still very early stage, infant stage. So we see this market means huge potential for overseas investor. Next page, please. Next page, please. Hello, next page. Yeah. Previous page, please. Why China bond currently is so attractive for global investor? I think there are 3 main reasons. The first reason I think is the yield attractiveness. Currently, the China-US Treasury bond spread currently reached the historic high at 240 bips. So I think the 240 bips gives everyone very strong confidence to invest in China, to buy China government bond. The second, I think the reason is the China bond market, because there is some kind of capital, such kind of still capital market opening process. So the correlation with global bond market or capital market is still very low. You can see the correlation sometimes is currently negative. So for big, very large asset owners like sovereigns, they see China bond is a very good asset class which can naturally hedge their global asset risks. The third, I think, is for a lot of index inclusion. So recent years, we see JP Morgan, we see Bloomberg Barclay, and recently, FTSE Russell also announced that they will finally confirm the China bond inclusion in next March. So we see more and more global index recognize China's bond market's importance and attractiveness, and also which means a lot of passive investors behind them will allocate more exposure to China. I think that's the reason for them invest to China, but in return, China market also give them a very lucrative, very profitable return in terms of their investment. If we look back in the past 5 years, if we convert all the global market, bond market return to US dollar denominated, in the right bottom chart, you can see the 5-year return in China bond market, average return 5 years is about 23%. It's almost double of the APEC average and also double the global average. So I think China bond market, I think in general, it provides a very good return as an asset class. Next page, please. Next page. This slide, we list all the regulations, new policies released in this year. Although there are coronavirus and a lot of market turmoil, but our regulators and market participants work really hard to make this market open and transparent. So we can see there are new regulation relaxation on FX derivatives as on the electronic trading platform. On the QFI expanded investment scope, as well as a lot of extended trading hours and extended trading settlement cycle. So we really work hard to make this market open, transparent, and adopt to global practice. Next page, please. So as a result, with the strong interest in China market, with the very good return on the bond yield, and with the strong support from the regulator in market opening, we see in recent 2 years, there are very strong, very robust growth in overseas investors' bond holding in China. From our CCDC perspective, we depository all the central government bonds, all the local government bonds, and all the financial policy bank bonds. So we just see the depository volume with CCDC has in the left chart a very strong growth. I think compared to last year, this year we will see, I think about 40% year-over-year growth in deposit volume, and the increase comes from CIBM Direct, which I think contribute about 80% of market share, and also we see a very strong growth from Bond Connect. I think this contribute about 20% of overseas investors' bond holding. And in the right chart, you can see previously only the pensions and the central banks are the major investor, but with the index inclusion, with the market opening, a lot of financial products, a lot of asset managers, commercial banks, broker dealers are also playing more and more roles in this market, and their deposit volume increased dramatically. And also you can see previously only the central government bonds are the products they are buying. Now they also looking at the financial policy bank bonds and also some of them are looking at credit bond like ABS and also some credit names. Next page. This is our internal figure. In terms of all the overseas investors' deposit volume, I think a majority come from Asia. I think currently Hong Kong is the gateway to China. Singapore is also another emerging entrance point. And we see a strong growth in the East Asia and also especially from Japan and Southeast Asia. Besides China, we see North America, US and Canada, despite the very complicated political issues, their investors also look at this market very seriously and pay a lot of stakes. And also Europe, we also follow the North America. There are also sizable investment. And also from Latin America, from Africa, and also as well as from Australia, there are a lot of pensions from Australia in this market. So I think the market is growing very fast. Asia is the engine, but we see a lot of other regions, especially Belt and Road regions, are also have very active activity in China bond investment. Next page, please. Currently, we see from the settlement volume perspective, we see in the 2020, we see because a lot of liquidity injection from different central banks, and we see there is a booming in the market trading and settlement volume. You can see in this year, the figure shows this year, the average settlement ratio, settlement volume is almost 50% increase above than last year average. And also you can see a lot of trading, although I think about 70% of bonds are holding by central banks and sovereign funds, but a lot of trading actually contribute by financial products, and I think also a lot of from the commercial banks. So you can see from trading perspective, financial products and also the central banks also contribute the majority of percentage. So you can see the different behavior of different investors. Central banks and sovereign funds, they are buy and hold, and so a lot of financial products and commercial banks and book dealers, they are kind of trading players in this market. Next page, please. As previously mentioned, there are two channels for overseas investors to access China interbank bond market. I think major is the QFIA and the CIBM Direct. So which I think we can label it like call it direct access. Direct access is directly the overseas investor filing at TBOC and can open account for their own account with CCDC and do the trading. And another channel, some of them you may know, is the Hong Kong Bond Connect. So you don't need to directly open the account in China. You can use Hong Kong the kind of infrastructure connection. So like it's more like CIBN Direct. It's more like a direct flight. And Bond Connect, you can like connecting or transition flight. So I think for the large and for the sophisticated investor, we still believe CIBM Direct currently is the main or the more popular channel to access. I think for a lot of reasons. The first, I think, is the transaction cost. Because it's direct, you don't have intermediary. I think we have done a comparison. The intermediary, such like trading and settlement cost of these two channels, CIBN Direct is only the 20% of the Bond Connect cost. So which means you can save 80% of your intermediary trading and settlement fees when using CIBM Direct. Or it's the same for QFII. Because QFII, when you use QFII, you also directly open account with us. So you are quite similar like CIBM Direct. The trading cost is the same. And the second, I think because of the you have your own account, so you can do a lot of non-trade transfer. I think that's particularly useful when you transfer asset manager, or you do such kind of non-trade transactions. And also for the central banks, for the commercial banks, when you use CIBM Direct, you can not only do cash bond, you can also do repo and also bond lending. But in Bond Connect, currently the only available trading product is the cash bond. So I think these are the core advantage. Additional advantages, which means you have more counterparties for FX hedging. You have more flexibility in the cutoff time, and you can also use your bond as collateral for your future transaction. You can place your central government bonds as future margin for your future transaction in China. So I think that's the shorter summary of the advantage of CIBM Direct. Next page, please. So when we talk about the market, when we talk about the trends, so this I would like to just briefly introduce our company, CCDC, which is the China Central Depository and Clearing Company. We are kind of the core financial infrastructure, especially for the bond market in China. We currently have access to almost all the onshore financial institutions. Currently, our market share is about the total 73% of total China bond market, and about 88% of the total China interbank bond market. Because in China, the bond market includes interbank bond market and exchange bond market, which I think exchange bond market is only maybe 10 or 20%. Majority are the interbank bond market. And also, because all the financial bonds and the policy bank bonds and also local government bonds are deposited with us, and all these bonds are very popular for overseas investors. Currently, about 90% of overseas investors' bond holding in China are actually deposited with us. So currently, we position us as overseas investors' gateway for them to access China. Next page, please. Next page, I want to share some market figures about liquidity improvement. Everyone complains China's bond market, the secondary market liquidity not that good, which is true in the past. But when we see these figures, we see it's not that bad anymore. We see there is a very dramatical change and improvement in the recent 1 year. I think that the reason is because our issuers like Ministry of Finance and also the policy bank bonds do a lot of market making supportive operation, and we do a lot of reopen issuance. And actually, we look in the new issuance here in the right bottom chart. You can see majority of the new issuance for the government bonds. I think the central government bond, about 66% are the new reopen. And policy bank bonds even more. I think above 90% are in the reopen. So reopen practice greatly improved the liquidity, and also a lot of market supportive market making initiative. So we see, compare with the previous turnover ratio, in the second half of this year, we see the central government turnover ratio is about almost 3 times. And the policy bank bonds is 5.5 times. I think it's also very close to US Treasury bonds liquidity. I think it's 8 to 10 times. So I think we are on the way to improvement. And I'm very confident that in the next 3 to 5 years, the liquidity we will reach the US Treasury level. Next page, please. And for some small and medium-sized investors, I think China ETF also provide them a very convenient way to access China exposure. Here, the China ETF means that some offshore asset managers, they will raise an ETF product in the offshore exchange. For example, like the Singapore exchange, like the London Stock Exchange. There's China ETF. The underlying bonds are in China deposited with CCDC, but investors, though, they don't need to go to China to open an account. They can use their local exchange house. They can buy the shares and they can share the increase of the China economy, and they can share the increase of China bond market growth. So I think we see such kind of ETF products grows up very fast. I think previously 2 years only less than 10 products, but you can see in the third quarter of this year, the figure reached almost 60%. We currently we see the listed ETF, China bond ETF in US, in UK, in Europe, in Hong Kong, in Singapore, and also we are still look forward to have the first one listed in Australia. Next page, please. And I think besides the China central government bonds and the policy bank bonds, I think China ABS is a very unique product. I think when the overseas asset owners like to allocate some China credit bonds. Because these China ABS are mostly, we see from this chart, they are mostly from such kind of China auto loan providers. So who are these names? They are also like such kind of Nissan Auto, the BMW, Volkswagen. This manufacturer, they also set up the financial leasing, such kind of financial companies in China. So they issued a lot of financial products, and such kind of ABS also have international rating. So we see a lot of overseas investors are very keen in these products, not only from banking, but also from the central banks and also a lot of financial products. Next page, please. And this year, we also see a lot of improvement in the trading side, especially in the CIB Direct. Previously, only Bond Connect users can use the TradeWeb and Bloomberg for their RFQ transaction. It's kind of a straight-through online STP transaction. But now, from this year, CIB Direct investor, I think covers over 80% of the overseas investors. They are now also allowed to use Bloomberg and TradeWeb. They can do the transaction online and do it by themselves for such kind of RFQ linkage with CFAX, and finally the settlement will do with CCDC. Next page, please. And for the trade settlements cycle, previously we onshore was only T+1 and T+2. T+0 and T+1, but a lot of overseas investors, because of different time zone, different custodian layers, different settlement model. So we accommodate T+2, T+3, and this year we also allow T+N, N can above 3. So I think from this perspective, this is only the accommodation for overseas investor. So we see the China, the regulator, the gesture is open widely for overseas investor to make it more global standard. Next page, please. And this I mentioned, it's no trade transfer. So I think this is also a unique feature of CIBM Direct. for some solving investors, they were maybe buy one financial products, use asset manager A, but maybe next year they want to transfer to another asset manager, so they don't need to sell in the secondary market. They can use non-trade transfer as long as they can provide some genuine supporting document for such kind of manager change. So I think this is very convenient for asset owners, especially big ones. Next page, please. And this is also the new service provided by CCDC. Previously, you need to mail the paper-based application form and agreement to CCDC for account opening. But this year and going forward, we will receive the online scan copy. So you don't need to mail the paper copy to us anymore. You can do it in your home and ask your custodian bank to scan the copy, send to us. We can open an account for you within 3 days. So I think it's almost very convenient and adopt to global practice. Next page, please. And FTSE Russell, as you may notice, it will announced to improve China bond in next year. So we will see a lot of new improvements in FX hedging, flexibility, a lot of account opening process will be improved. And also we will see a lot of kind of settlement cycle beyond T+3 will be more and more encouraged and implemented. Next page, please. So looking ahead, if we see next year, we will see a lot of new things will be implemented and will be introduced. I think the first is simplified filing. So the asset managers don't need to file each for their financial products. They can add filing at the asset manager level. And hopefully there will be no bank settlement agent agreement required for filing. So you can use your custodian agreement to replace a BSA agreement. And the second is the dual structure account opening. So you don't need to sign document directly with us. You can do it to sign we sign the custodian agreement with your custodian bank, and we will sign separate one-off agreement with custodian bank. So the account opening will be also streamlined and simplified. And next year, we are also working really hard with CCB to lobby the regulator to provide the overdraft line for settlement purpose at custodian bank level. And next year, I think hopefully overseas investors can allow to participate in the bond future market, and the government bond you hold, you can be placed in as the margin deposit for bond future hedging. And next year, we will also promote the China credit bond ETF. And we hopefully that such kind of ETF will help the overseas big sovereign investor to allocate more and more exposure to China credit bond names. And hopefully next year, we will see more clarification on the tax treatment. So the 3 years tax waivement will be expired next year. So we heard that the regulator is considering to roll over extending that. So we will see the final announcement in the next year. So I think a bit overrun, but in short, in China side, we from CCDC, we really would like to work closely with the CCB, with the Australian, our partners, to promote China. And also from China perspective, everyone, including the regulator, including the market participants, dealers, investor issuers, and also our market infrastructures, we really work hard to make this market transparent, to make the market the globalized, and also for investor friendly for global investor. So I think that's all from my sharing. Thank you.
Mr. Chen, thank you very much. That was such an informative session, and I'm sure everyone's got a lot out of it. It's not my job to try and summarize it, but I've just been taking a couple of notes here, which I thought might try to bring it all together. China bond market, it's big, it's growing, it's supported by strong and in infrastructure and institutions like CCDC. It's becoming more liquid, more sophisticated products. Foreign investment is growing, but still underrepresented. And the message for Australian companies here, despite your very nice comments about Australian participation in the market, is that when we compare ourselves to our other investors from the likes of the US, Canada, and Europe, Australian investors remain very much invested in the market. So that's my quick take. Let's now move on to our next keynote speaker, Ms. Xinye Kang, who's the Deputy Chief Manager, Fixed Income Portfolio Management Division in the Financial Markets Department at China Construction Bank. Ms. Kang has more than 11 years experience as an analyst, trader, then became the Deputy Chief Manager of CCB's proprietary fixed income department. And in doing so, she developed in-depth perspectives on China's bond markets, both the interbank bond market and the exchange market. She's currently in charge of CCB's Treasury bond portfolio management, as well as Treasury bond lending and primary market distribution. So I'll hand across now to Ms. Xinye Kang.
Thank you, Mr. Olsen. Good morning and also good afternoon. Thanks for having me to join this WebEx meeting and discuss investing in China bond market. As Mr. Chen just mentioned, the opening pace of the China bond market has been largely accelerated in recent years, and we are so glad to see the market benefited from diversification of participants and connect more closely with the international financial markets. Next slide, please. Okay, during my session, I will briefly go through the yield trend of China bond market in the year 2020. In this very special year, China's bond market showed a relatively independent trend, and I will talk about the next year, 2021, and then I will briefly introduce some of our services and strengths. Next slide, please. In 2020, China bond market made a very clear V-shaped reversal. The lowest point came in late April and the highest in November. And the yield level is still near the peak of the year. The core logic line is the COVID-19 monetary policy, bond issuance, and the recovery of production. So I'll just walk through this with this yield curve change. At the beginning of the year, the market enjoyed abundant flow of funds brought by the RRR cut. The yield decreased slightly. The Spring Festival of 2020 was early. Almost at the same time, the epidemic broke out. So the national holiday was extended 3 days into February because of the epidemic situation. After the holiday, bond yields dropped 20 basis points immediately. And soon after that, PBOC also cut the open market operation MOF rates by 10 basis points and injected sufficient liquidity into the market. The epidemic was primarily controlled in March, but the market was still pessimistic about economic prospects, continuing to push the yield down. So the sufficient liquidity pushed the short-term rates to low level. Some corporations took the advantages of the cheap money and arbitrage through structural deposits, which also drew attention of the regulators. So the tightening of the regulatory policies and the tightening of liquidity reversed the rapid downward trend of the bond yields. And that's pretty much the lowest point in April. So after the epidemic situations in China was well controlled, production began to recover. In May, after being postponed for 2 months, the 13th NPC and CPC-CC convened in Beijing. The conferences determined that we will carry out progressive fiscal policies and the fiscal deficit will be raised. As a result, a large amount of government bonds, including the extra 1 trillion epidemic fighting special treasury bond, had to issue within less than 8 months. This has been continuing exerting great pressure to the market in the rest of the year and became the driving force of yield going up for many times. So investors' risk presence has increased and the stock market of China surged since July, resulting in diversion of funds from the bond market. Although bond yields came down shortly due to the escalated tension between the China and the US government in July, but it went up again very fast again because of the huge issuance pressure. And also, as the COVID-19 was well controlled and the people were more and more confident about economic prospects, industry production almost fully recovered as to the level before the COVID-19, and economic indicators continue to improve. And PBOC did not have any more move to ease the monetary policies. And not only that, they also talk about the stimulus policy phased out several times since September. And all these indicators shows that the economy is rapidly recovering from the COVID-19 shock. And therefore, that the yield has rising after July and reached to the peak in late November, and now is still around the level. Next slide, please. And here are some supplementary charts. The upper left, this is the change in the structure deposits of commercial banks. We can see that the balance was reached the peak in April and gradually declined after April. And the upper right is the Shanghai Composite Index. We saw a rapid rise in July, which also gave pressure to the bond market. And the lower one is the comparison of the bond issuance, monthly issuance of government bonds, comparing 2019 and 2020. We can see that the extra issuance exerts large pressure to the market ever since May. Next slide, please. So before we move to the next year, I would like to spend 1 or 2 minutes with you to share some of my understanding of PBOC's policy framework. According to the most recent published article written by the Chairman Yi Gang, I summarized the PBOC policy framework into 4 goals and 5 paths. The 4 goals are currency stability, sufficient employment, financial stability, and international payments balance. And the 5 tasks are as in the right graph. Next slide, please. So just as we talk about the year 2020, we can also use it as a good example to understand how PBOC make policy decisions and took actions during under different circumstances. So before April, when the epidemic broke out, then no one know how it passed, what the path will be, and how long it will last, and most part of the economy were stopped. So the PBOC was mainly focusing on their the goal of sufficient employment. So they took the easy monetary policy trend and they cut the policy rates and they injected sufficient liquidity in the market. But when things going on, that when corporations are going back into business and they were taking too much risks as well as the commercial banks, the PBOC has paid attention to the risk factors about the new situation, and they stopped to inject more liquidity into the market. And while the domestic epidemic situation was soon under control, PBOC noticed that the new situation and the arbitrage weakened the effect of monetary policy and the stability of financial system. Therefore, PBOC and other regulatory departments jointly rectified the structured deposits and marginally tightened liquidity. So this change in policy direction was one of the main reasons of the V-shaped reversal of China bond market this year. Next slide, please. So looking forward, we believe that China still have very strong fundamentals. The economic growth turned positive in Q3 this year, and IMF predicts that China will be the only country with positive growth among major economies this year. It is expected that economic growth will remain at a good level in the fourth quarter and the first half of next year. And the annual economic growth in 2020 is expected to be around 2%. We also expect that the inflation won't be a big concern to the market because the food price has been falling, and since the recovery of production is faster than the recovery of demand, so we don't think the inflation will be a main concern for next year. And for the monetary policy, as we just discussed, the macro leverage ratio has come into the regulators' attention, and the central bank will ensure that the market gets reasonable sufficient funds and the market interest rate does not deviate too far from the optimal interest rate. But the next year, we will see that the PBOC will pivot between its four goals under different circumstances. It will take different action under the policy framework, but it will ensure that the market will be in good shape and is normally functioning. And for the bond issuance, that it won't increase significantly or even drop slightly, and the pace of issuance will be more balanced because we hope we don't lose 2 months like this year again. Therefore, we believe that the space for bond yield to rise next year is very limited. When the growth of the financing declines, the interest rate will also fall. The next slide, please. So CCB is one of the founding members of China interbank bond market, and provide various services to the investors. We ranked the #1 in government bond underwriting in the past 2 years, and we distributed 320 billion bonds to more than 300 investors this year. Next slide, please. We could help investors assess the interbank bond market through either CIBM Direct or Bond Connect, or both, depending on investors in need. If the investor choose CIBM Direct approach, we could help from opening accounts to trading and to settlements, etc. Next slide, please. So this is a procedure that we have drawn to how foreign investors to enter into the interbank bond market with the help of CCB team. And we have a long history of helping investors, even like the beginning of the CIBM Direct was launched. So we are confident that we can help investors to meet all their needs. Next slide, please. We're also aware about the problems that foreign investors may face when participating in primary market, such as that the information is scattered around different websites, and exchange of information will meet some barriers, and the procedures were less electronic compared to secondary market transactions, and there will involve more manual processing and more paperwork. Next slide, please. And we have been thriving to sort out solutions. We launched our e-trading platform last year, and more than 400 domestic investors have installed it. We designed a platform aiming to resolve the problem, such as timely data push, fast responding, less paperwork, and more streamlined procedures. And we welcome all kinds of investors, including foreign investors, to try out our system to improve your experience with China interbank bond market. Next slide, please. That's all I have for today. Thank you again all very much. Thank you.
Ms. Kang, thank you very much. That was a very informative session, and there's a lot there around China's policy direction, but also the steps that CCB is taking to assist investors get into the China market, which is terrific. Let's move on now. We're running a little bit behind time, so I'd like now to introduce as our final keynote speaker, Mr. Huayu Shen, who's the head of Overseas Non-Bank Institutions Division of the International Business Department at CCB head office. Mr. Shen was head of Foreign Exchange Policies Management Division. He's over 20 years of extensive experience in all aspects of the market. So I'll hand across now to you, Mr. Shen.
Sorry, can you hear me? Yeah, okay.
Yep.
Thank you very much, moderator. Good afternoon, distinguished guests. It's a great pleasure for me to tell you something about investing in China. My presentation consists of two parts. Sorry, yeah. My presentation consists of two parts. Why invest in China and how to invest. I hope it could bring you some insights. Sorry. Okay, it could bring you some insights about China's financial markets and help you with your future investments. Next slide, please. So the first question is why China? Next slide, thank you. So you can see China has become the second largest bond market and stock market in the world. By the end of November, China's bond market has exceeded 130 trillion yuan, equivalent to about 70 trillion US dollars. The stock market has seen a 40% growth, and it has outperformed all the other major markets in the first 11 months of this year. This is especially significant in the context of global pandemic. So in the bottom, in spite of China's large market size, foreign investors only account for 2.6% of bond market and 3.3% of stock market. Compared with other major markets, well, 10% to 50% of investment comes from foreign investors. China still has huge room for growth. The Chinese government believes that with more funds coming from abroad, the market would become healthier and more transparent. Next slide, please. Next slide, thank you. Yeah. So we can see some of the recent. So we can see some of the recent key progress of opening up of China's financial market. Starting from July 2019, the Chinese government released 11 measures. It set up the roadmap for further opening up. This year, the opening up has not slowed down in spite of pandemic, but accelerated instead. In January, allowing foreign investors to hedge their FX with more tools. In April, China removed the limits of foreign ownership of securities and fund management companies. In May, removed the restriction on QFII investment quota, simplify investment profit repatriation procedures. In September, released 2 exposure drops opening up in China's bond market and officially released a key QFII regulation, lowering the requirements for market access and allowing wider investment scope. All these changes have streamlined application procedures and removed the restriction to provide more enabling conditions for foreign investors. Next slide, thank you. So not only China's market are growing with high returns. bond market on the left, the return range from 3% to 5.4%. The right table shows PE and PB of global major stock markets. You can see the of Shanghai and the Shenzhen Stock Exchange are relatively small. So next slide, thank you. Another concern of investors is exchange rates. This chart shows our exchange rates against other major currencies during the last decade. We can clearly see that all the curves have been flattening in recent years. The analyzed volatility of RMB against US dollar in the past 3 years ranged from 4% to 6%, which is lower than the 5% to 21% range in another emerging markets. So in the past 6 months, RMB rose against USD by more than 8%, which means foreign investors stand to gain from both appreciation. Next slide, thank you. The reforms in China's financial markets also lead to inclusion of China's stock and bonds in global indices with increasing weight. So we can see that now it's important for global investors to take a look at China while managing their portfolio. Next, thank you. We have seen some attractive about China's and RMB assets. So let's move to the next part. How do foreign investors go about their investment? First step, you need to pick a scheme. Yeah, by previous speakers, there are 3 major investment schemes, namely CMBM Direct, Bond Connect, and QV. And the chart gives a picture of what kind of products are available under each scheme. CMBM and Bond Connect are both for bond markets. QV allow foreign investors to access both stock market and bond market with a wider investment scope, including the funds, futures, and the exchange market. So for CCBM Direct and QV, CCB head office will assist you with application documents and submit them to regulators. And the preparation for Bond Connect is mainly done in Hong Kong. So CCB Asia, our Hong Kong subsidiary, can provide some services. Next slide, thank you. Now some figures of each scheme for your reference. By the end of November, nearly 900 foreign investors have accessed China's financial markets through 3 schemes. Foreign investors now hold 3 trillion yuan bonds, which is equivalent to 470 billion US dollars, which with an average growth of 40% over the past 3 years. And this 470 billion US dollars, nearly 6% goes to central government bonds, and 30% goes to policy bank bonds. So this kind of bonds are called the interest rate bonds because we think this kind of bonds has no credit risk, only the difference of the interest rate. So we call the interest rate bond. So in fact, statistics shows that there has been 24 consecutive months of net buy of foreign investors in China's bond since December 2018, which shows more confidence in China. Next slide, thank you. So the last question may ask, what does CCB have to offer in all of this? Generally speaking, on the 3 investment channels, CCB offers one-step solution with diversified products and value-added service. In the middle of this slide, you can see 7 main products that CCB can offer for investors. including bond distributed by us, like interest rate bond and credit bond. And the products issued by us, they are NCDs with high rating, low risk, and good liquidity. Besides, we offer 6 main services, including bond trade settlements agency, custody service, FX, interest rate hedging, liquidity support, and so on. So next slide. Next slide, please. Thank you. We are the largest QFII domestic custodian in terms of ACOC. In the first 8 months, we account for 40% of the new QFII approvals. 9 of top 10 global custodians have appointed CCB as sub-custodian bank. Next slide, thank you. With benchmark rates of USD and other world currencies narrowing down around 0, the spread between China's bond and major currency bond become even more attractive. So besides the interest rate bonds, the Chinese credit bonds also proved to be a very high quality asset to be added to the fixed income portfolio of global investors. The 3-year AAA rating corporate bonds yield in China is generally about 18 bips higher than interest rate bond. So even taking into account of after swap yields, it's easy to realize 100 bips gain out of the investments on China's AAA credit bonds. Yeah, next slide, please. So also, China's capital markets has become the 2nd largest green bonds and ESG fixed income assets provider over these years. With green standards getting more and more in line with international ones, the Chinese green assets would be another meaningful diversification of your investment portfolio. Next, please. As for CCB RMBS, it's worth a minute to talk about. CCB is the largest RMBS issuer in China. Until now, CCB has issued 6 RMBS with AAA international rating and the volume totaled 70 billion yuan. It's a notable investment product for foreign investors with high quality underlying assets, competitive pricing, and more safety. By now, 24 institutional investors from United States, Japan, Europe, Singapore, and Hong Kong investing in this RMBS. Next slide, thank you. So the structure of housing rental rates listed in China Beijing Equity Exchange, CBEX, is in line with the international mainstream standards. It's a typical corporate style rate. Housing rental market is a new blue ocean market in China. According to the forecast of DTZ, the housing rental market value will be over 1 trillion yuan. Last year, we listed the first BPOC rates project in CBEX, which create a new channel to introduce different types of capital to support housing rental market. CCB, as the coordinator of the first housing rental rates in China, is trying to apply our to the implementation of more rates projects. Next slide, thank you. Yeah. As a part of our comprehensive cross-border investment solution, CCB PAM, CCB Principal Assets Management, the assets management arm of CCB, provide both standard and tailored investment products through mutual funds and separate accounts to satisfy the foreign institutional investors' demand. Next slide, thank you. We would like to show you the track records of investor products we manage which cover both China's onshore equity market and fixed income market. CCB Pound solution all outperform market major indices. Next slide, thank you. Last but not least, we have a service and support team of members from across the CCB group with expertise in laws and regulations. And CCB is willing to help you understand market dynamics, facilitate application procedure, and make wise, secure investment. To conclude, China's financial markets are thriving with new opportunities, and we sincerely hope that you can be a part of this exciting progress. We also believe that CCB can be a solid partner of yours. That's all. Thank you. Thank you.
Mr. Shen, thank you very much indeed. That was an extraordinarily interesting and comprehensive summation of opportunities and CCB's capabilities as well, CCB's capabilities. I now hand across straight away to my fellow colleague, Stephen Wolf, who's the country head for China at Macquarie Group, and he's going to lead the conversation around with the panel. Over to you, Stephen.
Hi, David. Thank you very much. We've got a great panel here today to look at the opportunities and challenges of investing in the China bond market. So with me here in Shanghai, we have Rachel Thompson, who is the Minister Councillor of Treasury from the Australian Embassy in Beijing. Online, we have Michael Chen, Acting Head of Overseas Client Department for the CCDC. We also have Xinyi Kang, who is the Head of the Financial Markets Department. We have Yangxi Jiang, who is a strategist for CCB. And we also have Mark Burgess, who is the Chairman Asia Pacific for OMFIF. So we've heard a little bit about the market, the capital markets here in China, and particularly the bond market. I think for a lot of the audience, the capital markets here in China are quite different from what we might normally expect in the West. If you look historically, most corporates in China have financed their activities very much through bank debt and debt instruments rather than through equity markets. So it's almost the inverse of what we'd expect in the West. So it's quite a different market. There's also some areas of unfamiliarity. I think for many of the listeners, there's Bond Connect, there's CIBM, there's different situations regarding ratings. A lot of the bonds are rated by domestic agencies, but more so now looking at international ratings agencies. And we also have a difference in tenor for a lot of the bonds. A lot of the corporate bonds, particularly here, are much shorter tenor. But it is a large market, $16 trillion US. It's growing rapidly. It's increased more than 60-fold in the last 20 years. In 2000, it was just 214 billion. So now it's grown to be the second largest bond market in the world, and definitely something that you'd imagine would be something that would be on the radar screen of most institutional investors. The other interesting factor I find is that from a corporate bond perspective, it is the only major bond market where from a government bond perspective, it's the only major market that is offering a positive net yield. So I think there's a lot of interest in the market, and rightly so. It's not a market without some challenges and without some problems. There obviously on the corporate side, there's been some publicised defaults in recent times. But what I'd like to do is, in the first instance, to try and help us demystify some of this, to go back to Michael Chen, who we heard from earlier, and just get him to really summarise, if he can, the main differences between the two access schemes, being the direct scheme and the Bond Connect scheme, bearing in mind that I think many investors would have been more used to dealing with the Hong Kong markets and using Bond Connect as a potential mechanism. What are the differences and what are the strengths and weaknesses of those two channels? Thank you, Michael.
Michael,
we can't hear you.
Oh, sorry. I just mute myself. Yeah, I just repeat. For overseas investors, as you mentioned, there are different channels to access China bond market, especially the CIBM Direct and Bond Connect. I think compare these two channels that I previously mentioned, cost I think is the first thing everyone should to aware. I think we do a very detailed analysis. From our observation, currently the cost saving from CIBM Direct is obvious. It's about 80% of cost saving. So I think especially for these large and very sophisticated, heavily trading investors, and even for some small and medium-sized investors, because their volume is very small, so maybe they are also very cost sensitive. So I think cost thing is one thing you need to bear. And the second thing I think you need to aware is the investment scope. As Mr. Shen mentioned, if you want to look at both equity and fixed income market, I think personally, I think QFI, I know previously some of you may have very bad experience for the QFI repatriation issues, but I'm confident that China's door is open wider and wider, will not go back to maybe 5 years or previous bad experience. So I think QFI for my personal view is maybe the best solution for if you want to look at both equity and fixed income. You can use QFI and enjoying the CIBM Direct cost saving, because it's actually covers the CIBM account opening, everything is the same. And at the same time, you can also use QFI to equity investment, and more important, maybe future, you can also use QFI quota for bond future investment, so you can hedge your bond interest risk. So I think which is very nature in global market. So I think QFI provides you a more flexible way in investment goal. And also you can use QFI CIBM Direct scheme to do such kind of a bond lending, bond forward, and also repo if you are a commercial bank. So I think these are more flexible. In CIBM in the Bond Connect scheme, currently only the cash bonds are available now. And the last I think you need to consider, I think is such kind of a clear legal framework. So CIBM Direct, QFI, they are all the bonds are under your own name. But in Bond Connect currently there's the omnibus account structure. So some foreign names, and as far as we know, central bank solving intentions, they don't want to other commercial bank to on behalf of them to hold these bonds, and they maybe have some legal potential and also maybe some tax treatment, because the bonds not under use, maybe you can tax special tax treatment, you can have tax waiver, but it's not under you need to provide a lot of supporting documents, justification. So it's very complicated in some cases. We have some case in such kind of stock connect investors. They are solving, but they have a lot of issues in tax waiver. So I think these are all the considerations. So I just want to share. I think both CIBM Direct, QFI, and the Bond Connect have their own proposition and have their own advantage, have their niche market, niche investor target, all the investors. So everyone need to aware all these kind of things and select the best suit for them. Thank you.
Thank you, Michael. Yeah, I think that's a good insight. It is a market that has a few different channels. Obviously, they each have their strengths and weaknesses. So it probably does require a little bit of investor education and investor sort of due diligence. I'd now like to call on Xinyi Kang. Traditionally, in the bond market, most foreign investors have shied away from investing at the primary issuance stage and have chosen to invest more commonly in the secondary market. I'd like to ask you about that sort of characteristic, and whether you think there's reasons or trends that might change.
Yep. Thank you, Mr. Wolf. Just as you just said, that when we compare the China bond market and to other international markets, that we can see a lot of differences. And for a primary market, that it does not like the secondary market, that it lasts every day, and you can also find price quotes on the market. It has this auction schedule. You have to follow the auction schedules to send your bidding, and also the procedures is quite different from the secondary markets, and that plus the language differences, and it will add difficulties to the foreign investors. But for as CCB is also an investor in China bond market, that we have benefit a lot from participating both the primary market and secondary market, because the price mechanism of the primary market and second market are different. If you participate in both markets, it will be easier to grasp the market opportunities and win higher returns above the market average, especially when we know that now more and more long-term institutional investors have joined China bond market. The primary market has the characteristics of bulk supply, that you don't have to place like 100 orders to make to purchase enough bond to meet the purchase demand. For the primary market, that you can just bid one time to purchase enough bond for the investment need. However, the procedures are less electronic and less accessible. That's why that's also a challenge for even the domestic investors. CCB has always strived to sort out the solutions to help investors to access the primary market. We think that technology might be one of the solutions. That's why we developed our own trading platform last year, and until now that we have more than 400 domestic institutional investors have launched it, and it enhanced our trading procedures largely. That's why that I think this WebMax meeting is very necessary for us from different backgrounds, different experience with trading, and I know that I'm aware of that there are a lot of differences between the markets, but I think the only way that we sit down and we talk to each other and find out a way to solve the problem and reach the agreement, and that I think that's the only option here. And also I want to mention that for in China's interbank bond market, it's not like when some people would imagine that the primary market will be very little, that you have very limited time space. If you get on the paces, that you get used to the paces, it won't be that hard, because for China the bond market has grew very rapidly. The auctions host almost every day, like policy bank bond auction that it hosts every day, and for treasury bond it hosts 4 or 5 times a day. So considering the savings of the time and energy of inquiring like more than 100 times on the market, I think primary market might be a solution, might be an answer for long term and the real investors for foreign institutions.
Thank you, Ms. Kang. It's quite a different market, and I think that was pretty good insight into not trying to restrict investors from just a particular part of market, but being willing through the use of technology and through the looking at the different nature of the market to participate in the full scope. One of the things that I thought was interesting was you saw some quite substantial moves in the interest rates and bond pricing over the course of the last year. Now, obviously, 2020 has not been a normal year. And we've seen a lot of influence from the macro environment on bond pricing. So I'd like to call on Mr. Yangxi Jiang, who is the strategist for CCB, just to, I think some of our attendees at the conference today would be interested to hear from CCB about what your thoughts are of the macro environment going forward and how that might impact bond pricing.
Okay, thank you. Actually, we do agree with Ms. Kang's statement. In her presentation, and we do think the keyword for this year, for the next year's environment, can be summarized as back to normal. And we have in our baseline estimation, we think this year's GDP growth would go back to 2% of this year, and for the next year we are expecting almost 8% GDP growth and a moderate level of the inflation environment. This is nothing very far from the market consensus. But what I want to remark a little bit more today is about the inflation environment. Well, in our baseline estimation, we do have an expectation of the CPI level of the next year is around 1.5 to 2%. Maybe it's still a very moderate level and won't cause any change in the monetary policy of PBOC. But actually, we do have two concerns. The first one is in a short view that we need to focus more on the structural difference between China and the outside world. As Ms. Kang just mentioned in her presentation, that China's inflation environment can be in a moderate level because of the recovery of the production supply chain as well as the rebounding demands. But actually, this is not the same situation for other countries in the world. So we are very concerned about the rise, especially the pace of the rise of PPI in the first half of next year. And we do think industrial inflation is more important than consumption inflation for the first half of 2021. And in the midterm view or in the long-term view, I think that's a very important change that foreign investors may ignore. That is the understanding, especially the governor's understanding. It's about the change of the governor's understanding about inflations. Recently, we see Mr. Zhou Xiaochuan published several essays and reports talking about this topic, talking about the definition, the concept, and the measurement of inflation, where he thought the inflation should, the concept of the inflation should be broadened and covering the to take the asset price changes into consideration. And we think that's a very important signal in a political framework that we need to further or broaden our understanding and our evaluation on how on the inflation level, and especially considering the very big picture of or the very big voice of MMT, we think the very important thing is the inflation environment in the future is not just about industrial price index or the consumption price index. We should take more focus on the asset price as well. And this is the two remarks I want to emphasize a little bit more here. That's it.
Thank you very much, Mr. Zhang. I think we've heard that the bond market here is essentially split into two areas. We have what I think one of the previous speakers referred to as the interest rate bonds, which is essentially central government bonds and policy bank bonds, which are effectively extremely low or close to zero credit risk, and it's really just a yield play. But then, and in fact, most foreign investors have concentrated their flows into those two types of bonds. About 86% of foreign investment is in either into central bank or policy bank bonds. But there is a 15% of investors have invested in credit bonds. And those is an area that hasn't been completely without trouble. In fact, one of the issues I think that's resulted from China's a remarkable recovery from the COVID pandemic is that the level of stimulus has been a little bit less than has been expected, and certainly substantially lower than many countries in the Western world. But it's also we've probably entered into a situation of some tightening in the financial market liquidity, which has put some pressure on some of these credit bonds, and we've certainly had some issues. So I'm really interested to turn to Rachel now, and just to find out how the regulators have been dealing with this recent turbulence, and how does that fit into the broader picture for the domestic Chinese bond market?
Terrific. Thanks, Stephen. And it's always a pleasure to join in the work that ACBC does to bring people together to share perspectives and information on important topics like this. I'm really happy to be with you today, joining from Shanghai, and happy to share my thoughts with you, noting, of course, that they're my thoughts rather than being the official position of the Australian government. I think other speakers have obviously traversed in a lot of really helpful detail about the range of mechanisms that investors have to access China's bond market. But it's also really important, particularly for foreign investors, to be able to put all of those mechanisms in the context, in important economic and regulatory context. As others have noted, China's front-running recovery from the coronavirus pandemic is clearly making markets here an attractive option for investors seeking yield in what continues to be globally a very low interest rate environment. But even before the pandemic, financial regulators in China have been on a mission to create a modern capital market for China. I mean, such a system, I think, as Stephen, you mentioned, would help financial institutions, particularly Chinese banks, to diversify their sources of capital away from deposits, and a really important part of ensuring the appropriate capitalisation of China's financial institutions. Would also give households an important means of diversifying their investments of wealth away from domestic property, which is only going to become more important as China's economy continues to grow, and we expect household incomes and wealth to continue to rise. And I think particularly during the pandemic, what we've seen is an ongoing focus on having mechanisms such that that ensure that credit is actually allocated and that risk is priced according to business fundamentals. It's particularly important for China's SME sector, which is such a significant employer. And of course, the focus on employment has been a really important part of China's economic recovery to date. And so a really fundamental element of developing a modern capital market is ensuring that investors have confidence in the timeliness and the quality of the information that they're receiving. This is, as Stephen mentioned, we've had a spate of bond defaults by a number of provincial SOEs, which I'm sure you've all read about in the news, and I don't propose to go through in detail. But that's been a significant enough event to cause the Financial Stability and Development Committee, chaired by Liu He, to remind all parties in the bond issuance process of the need to behave ethically and honestly. Defaults are, of course, a part of any healthy capital market. What matters is that they're undertaken transparently and according to market rules. The recent SOE bond defaults, I think, too, it's important to remember they all have unique characteristics in terms of the underlying economic and commercial drivers, the relationships between these entities and relevant provincial governments, and their significance to provincial economies. But they do form, I think, part of a growing body of evidence for investors, whether they be domestic or foreign, of the need to revisit old assumptions about the extent to which individual SOEs, particularly at a provincial level, are implicitly backed by provincial governments. And this, of course, came into really sharp focus last year with 2019's landmark financial event, which was, of course, the failure of Baoshan Bank. I think very recently, too, we've also seen regulators start to take action against alleged misbehaviour by local credit rating agencies, which combined with, I think, the ability now for a number of international credit rating agencies like S&P finally being able to establish their business in China, is a further sign, I think, of regulators' seriousness in developing a capital market, particularly a bond market, in which investors can have confidence. And I think while all of this is clearly a welcome development for foreign investors who come from more mature markets, I wouldn't want to, I guess, leave you with the impression that that the creation of this more modern functional market here is going to be an easy process, that it will be smooth, or indeed that it will be quick. And ultimately, kind of when and how individual foreign investors choose to enter the China bond market is ultimately always going to be a judgment weighing up the risks, potential returns, overall fit with mandates and any specific governance requirements.
Thank you, Rachel. That was, I think, very insightful. And to call on our last panelist, Mark Burgess, I'd like to put the question, given this, our audience is mainly, as I understand it, institutional or potential institutional investors in the Australian market, looking to potentially invest into the China bond market. I'd like to hear from you, Mark. What role do you think the China bond market really is going to play for institutions in Australia in particular, and also, what role should it be holding now, and also how relevant is it going to be into the future?
Thanks very much, Stephen. I think it's absolutely inevitable that global investors, including Australian asset owners, will allocate more to China, and particularly the China bond market. Its sheer size and scale, as we've mentioned today, the yields are currently attractive, but also it's a market that currently acts in a differently diversified way, which everyone is seeking in the current environment, which is defined forms of diversification. I think the other bedrock that gives confidence to investors over time is that China has had a very clear set of policies here. In fact, if you think about it, the policies are being put in place now over a number of years and are being delivered. Policies such as the opening of the market, making it easy to access the market, but we're also seeing in other areas, for example, foreigners being able to own domestic financial institutions in certain areas has been delivered. And even the most recent developments, and it was mentioned by Rachel, where we're seeing China gradually head towards an allocation of risk, deciding who bears risk when defaults occur, and defaults will always occur regardless of the success of an economy. I think that's indicating that there's a real path of development of a capital market, and foreign institutions are definitely need to get access to it because of its sheer size and scale. There are some further developments. I think a couple have been mentioned today: the use of the derivatives market, the use of futures by foreigners, more sophisticated things such as repo markets and bond lending, and even the shape of the curve. Some fixed income investors would argue they would like to see it slightly different. But it is inevitable that people are allocating to China. They will continue to allocate to China, and in fact, people are moving up the curve in terms of their knowledge. I'll just finish because we've got a short amount of time, but the way asset owners are doing this is in multiple ways, but broadly speaking, with the inclusion in indices, but just in terms of the way they asset owners think. And there are really three broad asset owners that are going to allocate more, which is essentially pension plans, sovereign wealth funds, one of which I used to manage, and even central banks are going to allocate more, I think, to fixed income in China. But the way they'll do it in broad terms is either through an allocation to emerging markets bonds, Asian bonds generally, and trying to get access to the Asian growth story and the mix of allocation there. Or now, even more importantly, I think China is very clearly a global bond allocation. And I see this with global bond managers who are making the decision of where China fits when compared to others, such as the US or the European bond markets. And so China really has developed significantly. It's something that all asset owners must be on top of. And you can just see from today's panel, there's a lot of thought and consideration going into the policy. And it's great that we've started off this capital market series with a good look at the bond market to start. Thanks very much, Steve.
Thank you very much, Mark. I'd like to just close off the session by thanking all of the panelists. I think in the sort of the short period of time that we had, I think we've now got, had some insights into how we may invest and what the different options are, whether we should be looking at the primary or the secondary market, some insights into what the sort of the macro outlook is like. I think a real look at some of the issues around the market, and I think obviously the defaults get a lot of press, but given the size of the market, it is something that's inevitable, and it's not something that should necessarily be blown out of proportion. And given both the size of the market and the strong growth of the market, plus also these different access channels, it's clearly a market that's that is very, very relevant to institutions in the region. So I'd like to pass back to again say thank you very much to the panelists, and I'd like to pass back to David.
Thanks, Stephen. I'm very conscious of the fact that we're just about to run out of time. We have run over time, but I'd just like to thank everybody for listening in today. It's been a terrific start to the series, and I'd look forward to welcoming everybody to the next session. Before we close, though, there's one final short presentation or short comments from Daniel Boyer, General Manager Greater China for Austrade. Over to you, Daniel.
Thanks, David, and thanks to all of the speakers today and to everyone who dialed in. I've certainly learned a lot, and I suspect I'm not alone. The timing of this discussion could not be better in many ways as we approach 2021 and reflect on 2020. This year, the China bond market has been the only A+ rated sovereign debt market yielding greater than 3% over 10 years. China's inclusion in the Bloomberg Barclays Global Bond Index, the JP Morgan International Indices, and its pending inclusion in the important FTSE World Government Bond Index next year are all important milestones that deserve reflection. I want to thank CCB, OMFIF, my team at Austrade, the ACBC, David and his team in Melbourne, and the broader AusCham team, particularly Stephen for moderating, for putting this event together, and I look forward to the next series of events in a better, I hope, 2021. Thank you.
Thank you. Goodbye.